Howdy there, folks. Welcome in. Very busy video here today. A lot of videos to react to. Okay, first one up here is this one I want to react to. This is the most front-loaded interest rate hike cycle in decades, says Mohammed El-Alarian. Second video, this is maybe the one I'm most interested in reacting to here today for you guys and giving my opinion on this, is investors should be using a barbell strategy right now, says Josh Brown. So we're going to obviously hear what his frame of thought is around using a barbell strategy right now, in my opinion on that. Okay, and the third video, this one just came out about a half an hour ago. Legendary investor Tudor Jones says we are getting ready to deploy our recession playbook. So what is his recession playbook? Is that investing in certain types of stocks? Is it cryptos? So we'll hear what Tudor Jones has to say. Hope you guys enjoy this as always. Thank you so much for joining me. We are, we're well over 15,000 subscribers at this point. We might be approaching, I don't know, 15,400 subscribers or 300 subscribers, something like that. So thank you everybody for joining me. As always, right now I'm in North Carolina. Okay, North Carolina at the moment here today. If you're looking to join us in the private stock group this week, you want access to the Discord chat, the Palantir Discord chat, the Tesla Discord chat, Meta, AMD, and all the other stocks. Check out the pinned comment down there to apply. You also get access to our weekly investor report and all my different course curriculums out there, okay? So that will be pinned comment down there. Alrighty, guys, let's jump straight into this.
That the Fed, humbled by staying too long and saying transitory, is now staying too long in terms of raising, and we don't know yet. We haven't had an earnings season. We don't know how it's really affecting things. They may break something. We may already be in a sharp slowdown. Maybe they stay at this party too long, the tightening party. You don't think so?
So there's two elements to this. Can they stop? Can they pivot? No, they cannot. They cannot because the data doesn't give them enough of a green light, but importantly, their credibility has been hit really hard. Will they end up overdoing it? Most likely, yes. So they've gotten themselves...
If anybody watching this doesn't know what he's explaining there around credibility, just to explain that, basically, there's a belief that the Fed basically has no clue what they're doing, essentially, and you know, whether you agree with that or disagree with that, there's a perception out there because you know, basically they were way behind on raising rates, and so there's a view that the Fed has lost credibility and they kind of don't really know what they're doing, and they maybe only know how to help the market, and so that's an issue the Fed's kind of working against, and they got to get that credibility back. And how they're trying to get that credibility back is like, we're going to be tough guys. We're going to keep raising rates. So that's what he's explaining there.
This hole, and unfortunately, they don't know how to get out of this hole. There's no ladder out of this hole. People have to realize there's no ladder out of this hole.
Should we say, gee, you guys, your credibility was damaged. Now you've got to regain your credibility. Is that good for us and for the country that they have credibility, or are we paying for their mistake with a recession that we really, you know, I don't feel like paying for their mistake with a recession just so they can regain credibility.
Well, first of all, you have no choice but to pay for their mistakes. And that's one of the tragedies of the situation. Yes, we're all going to pay for their mistakes. And some people are already paying. There was another concern that you brought up, Becky, this morning with Roger, which is it's not just about inflation, recession. It's also about financial stability. That's the third leg of this thing. So yes, Joe, I don't know how we can avoid paying for this mistake because they have been late. They mischaracterized inflation as transitory. When they finally recognized their mistake, they didn't act. Remember, in the middle of March, when we printed the February inflation print over 7%, they were still injecting liquidity into this economy. That's last March.
Mohammed, wait a second. When you say the third part of the equation, the financial stability, do you think there is the risk that things will be broken in the markets if they raise another 75 basis points?
This is the most front-loaded interest rate hiking cycle we've had for decades. We're coming from zero interest rates. The whole system got conditioned to believe that zero interest rates was forever, that injections of liquidity were predictable, and now we're adjusting. The UK has given us a warning sign.
But there are people in the market who still haven't taken...
And that's why the market has been such a drama show this year. I mean, how do you get the NASDAQ down, 32% or whatever year to date? How do you get that to happen? Well, you basically throw in a situation that no one ever had foresaw coming, which is just a incredible amount of rate hikes all simultaneously, right? If we go ahead and pull up the NASDAQ here, what are we looking at here year to date? 33.22% year to date for the NASDAQ. You have to be flipping my flapjacks. That's insane. I mean, just an insane move down. NASDAQ's only had, a few years ever this bad. It's an incredible year. Now we'll see if we get that November, December rally. But if we don't, let's just say hypothetically we don't get a November, December rally and we just continue to sell off through the remainder of the year. What are we looking at? A down 40% NASDAQ? Down 45%? That's just crazy to even conceive of a potential where the NASDAQ drops almost in half in a given year, right? Or anywhere even remotely close to that. Like, this is crazy to think. Even a 33% move is extraordinary. But when you talk about this level of rate hikes, and it's not done. That's the thing. The market's already kind of prepped for this, so do keep that in mind. But the market's already prepped for 2 more rate hikes minimum. A lot of people are thinking 3 more. So we got probably another 75 coming, and then maybe a 50 or 25. But that's going to really be dependent upon inflation. CPI comes out on Thursday. That's going to matter in a significant way.
Fed seriously, so they have not gotten themselves to a place where they're not going to have massive issues if the Fed doesn't slow down?
So first of all, this is the non-banks, not the banks. So that's the good news, because the banks are in the middle of the payments and settlement system. The non-banks are not. So that's good news. Yes, there are certain. You can start with the zombie companies who are finding it much harder to refinance. And if they can get refinancing, the cost of this refinancing makes their numbers look completely different. Mm-hmm. Then you can go to various investors who over-levered. That's going to be an issue. So, we have to keep an eye on the third element, which is financial stability. It's not just about inflation and growth. It's also about financial stability.
That's almost an argument for slowing down and maybe only going 50 basis points of that at the next meeting, just because it's not going to help your credibility. If you're doing this for your credibility, things break and you have to instantaneously backtrack like the Bank of England.
I'm at 50.
Okay, so
I'm at 50. They don't give a damn, but I'm at 50.
Well, you think they'll do 50?
No, I want them to do. I think they should do 50.
They can't.
I think
they absolutely can't. If they do 50, then we will be at this table talking about stagflation.
So we have some people on saying, who was it, Mr. Wonderful? There are companies that they're not even noticing any slowdown at all right now. And then I don't know if I think that employment reports are lagging, so that could happen really quickly. We could see some issues there, or maybe not. But is the economy really, really still strong? And can we use 3.5% as an actual real employment number right now?
So I think the labor market is strong with one really important qualification: labor force participation, and that came down again. And remember, there's 2 answers to our issues: more labor force participation and more productivity. That is what we need, and that solves so many issues in the economy today. And the labor report was strong across the board except for labor force participation.
Do you think, Mr. New Normal, do you think because you sort of coined that term, do you think there's a new normal in terms of how we do business and how we work in this country in terms of hybrid, remote?
So I think of us as, and you're not going to like this, Joe, but as on a bumpy journey to a new destination. So what does the new destination look like?
Yeah.
First, tighter financial conditions. No more zero interest rates, no more injections of liquidity. That's gone.
People at home in their basement on Zoom calls?
No, hold on. The second element is a different type of globalization. And the third element is we're going to struggle at the global economy to provide high growth. We don't have potent growth models anymore. The US is in a much better situation than other countries, but the globe as a whole has a...
I would have loved him to get a little further into those points. Yeah, in terms of the globe, you really have to take that on a country-by-country basis. You can't just say all countries are the same, right? They're all going to react differently. And in terms of getting high growth, I mean, there's going to be some countries that, in my opinion, I'm very bullish on for the next decade. Actually, India is one of those that I think has huge potential over the next decade. I think they're going to steal massive amounts of jobs away from places like China, to be quite frank. I see a lot of companies starting to move production to India in a major way, and so I think a country like India is actually going to prosper in the biggest way they've ever have over the next decade or so, right? I think the United States continues to be in a very strong position because we continue to have the leading companies in the world, and we're going to likely stay in that position because of the way the venture capital space works, specifically in the United States. And so the next, Meta, the next Apple, the next Microsoft are much more likely to come from the United States than other various places. So, you gotta take that on a country by country basis there. But yeah, I mean, in terms of this whole interest rates were going to be this or that. I obviously have a lot of respect for Muhammad there, but in terms of that, it can change really quickly. I mean, a year ago, the thought process was so different, and now we're in such a different thought process, right? A year from now, it can be a whole different thought process, and who knows, we could be back at 0% rates again. If the economy, here's the thing, if unemployment was to tick up in a significant way for any reason, you know how fast they're going to cut rates to zero? It's going to happen really darn quick. But in order to see that, you got to see unemployment go to like 5%-ish or over. That's when, the Fed would panic and basically be like, drop rates low. We got to start pumping liquidity out there and things like that. But is that impossible to happen in a year's time? No, it's not out of the realm of imagination. No, imagine a scenario where unemployment stays actually relatively low, the economy stays pretty good, and we have consistent rates at 4.5%, 5%. Man, that would shock everybody, because there's such a belief now that the only way this system works, the only way the United States economy works, is if we have rates near zero. That's a belief. Imagine there was a scenario that plays out, and we're at 4.5% or 5%, and the economy's still chugging along and unemployment's still incredibly low. That would be the thing that shocks everybody, because a lot of people don't even think that's a realistic possibility now. And if that is, that's going to change everybody's thought process moving forward about what does it mean for the United States to be successful in different monetary cycles, which is, I think, would be pretty darn intriguing. I hope it plays out that way, because it would just prove so many people wrong that are of this belief that the only way we have success in the stock market and business and anything is because we got rates near zero and the Fed's pumping liquidity out there. We'll see. And obviously certain folks are making bets against this, right? And, I just always say, it's a dangerous bet to bet against the U.S. economy and to bet against Americans and to bet against, the system we built in this country, which is very capitalistic and has a lot of incredible people that do incredible things and attracts a lot of the best talent from around the world, right? It's not just people that were born in America. We attract a lot of the best engineers, the best business people from around the world. We attract those folks to the United States as well, right? And they almost become like, quote unquote Americans, right? Think of Elon Musk, right? The richest man in the world, or one of the richest, right? He's not technically an American, but basically he is an American, right? When you really think about it. So, there's so many various things we can go over there. I'm really excited to get into this one here. Investors should use a barbell strategy now, says Josh Brown. Okay, this video is actually from a couple days ago, and then this video is from about 30 minutes ago. But this one I think is really good to react to here.
Smartest people I know yesterday, Nick Colas, who I know you know well, yes. And the main thing to keep in mind here is we have never had an inflation spike that was cured by anything other than a recession. Not all recessions have been caused by inflation, of course, but anytime we've had a 5% plus spike in inflation of any duration, the answer has been a recession. So, and I said this on the air, and I'm brawling with people, and nobody wants to hear it, and I know it gets repetitive, but we have 11 instances of that. So you want to roll the dice? You want to say this is the one that goes differently? I don't think that anyone should be doing that. So it's not fun to be bearish. It's not fun to be negative or pessimistic, other than if you understand that the carnage of today is planting the seeds of expected returns tomorrow. And as markets fall, two things everyone should be reminded of two things about bear markets. The first thing is they end all the time, every single.
Before he gets in that, something that really bothers me about this market is folks not acknowledging the fact that we're in recession right now, and we've been in recession. That really bothers me, and I think the market would feel more comfortable if people just admitted the truth. The truth is we are in recession. You go to any econ class in college, and the first thing you learn is 2 straight quarters of negative GDP, and that's exactly what we had, okay? Not only that, look what's happened with company earnings. A lot of companies' earnings are falling dramatically, right? Look at a company like Nike, one of the best companies in the world, where their EPS falls something like 22% last quarter. when you take those factors in, right, and also an overall worry, that's something that's consistent in recessions, companies worrying, pulling back on maybe advertising spend, things like that. So that's all the components you have. The only component you don't have that some people associate with the recession is high unemployment, right, which is not something we have. But we have almost every other condition. Massive financial contraction, values of stocks in assets in general going down in a considerable way, negative GDP 2 straight quarters. You factor all these things in, companies' earnings per share going down in a massive way, people not wanting to take any risk. All these things are consistent with recession. Admit we're in recession. It would be healthy for the market instead of trying to act like we're not in recession, but we might go into recession. It's like, dude, we're in recession right now. You do realize that, right? I just wish all these Wall Streeters would just admit the truth. And unfortunately, especially because it gets into politics, you got around midterm time now, that a lot of people don't want to admit the truth around that for political reasons. And it's very, very frustrating. Very, very frustrating. But I think it would be healthy if we just admitted the truth, to be quite frank, okay? All right, so let's get back into this here.
Them. The second thing, more interestingly, is that as stocks fall, expected returns go up. So the money that you're putting into the market today, it's the most uncomfortable investment that you could make, 401k or otherwise. Any contribution you're making, you literally feel like you're throwing money into a wood chipper. You're not. You just might have to be patient before you see that pay off. But there's never been a market like this that wasn't viable. The real question is, what can you live with? Are you investing the right amount of money based on your own risk tolerance and your own financial situation? If you're not over-investing and you're not using leverage and you don't have ludicrous expectations about overnight gains and you're investing in a diversified portfolio, it could suck for another 6 months. It's entirely feasible, but that's not why we're doing this. We're not doing this so that we can have a party in March based on what the returns are from October. If that's what you're doing, you're playing a different game than most Americans trying to save for retirement.
I love that. Bear markets end, 100%, right? And you basically when you're buying in a crash scenario, you're getting these incredible discounts on stocks, which just means higher returns over the coming years, essentially. And that's the way it always plays out. And when you're investing into a frothy market where stocks are obviously trading at pretty extreme valuations, it's basically stealing gains from the future, right? Let's say Tesla, let's just use that as an example of a stock. Let's say Tesla was trading at a $100 billion market cap today, right? Well, that would mean a lot more future returns for that stock, right? But it's not. It's trading at, let's say, a $700 or $800 billion market cap, whatever, right? So that means much less returns for Tesla in the future than if it was valued at $100 billion, right? And so these are just some things to kind of think about here in regards to all different stocks. And the higher priced a stock gets, right, the more it's stealing returns from the future, the more undervalued it is, the more your future returns just went up, right, as long as the business model is the same. So this is just a very important factor that I think some folks definitely miss in the market, and you don't ever want to forget that, okay?
Right. And, we are seeing, as we talked about in the last hour, a lot of the things, these things go in waves. There's a sequence to how bear markets unfold. And part of it eventually is the stuff that people thought could keep them out of trouble starts to feel like it's getting you into trouble, whether it's the big NASDAQ bellwethers or whether it's the stuff that's supposed to be, kind of safe. So that seems to be like it's coming around. And even on a more fundamental basis, I mean, FedEx, it's a quirky situation. The stock was really hit tremendously hard before we got these reports today of an incremental warning. It ended up down 0.5% today, right? So it's a dynamic system. Some stuff's been priced in, maybe not all of it. And I guess the question is, do you want to just sort of wait until it's more comfortable, or do you want to brace for, listen, the overshoots happen on the downside in a bear market typically?
Yeah, so I think you want to stick, if you have a strategy or a multitude of strategies in a portfolio, 2, 3, 4 different things, what you don't want to do here is start to violate the rules based on your gut instinct. So the tactical strategy that we manage for clients is technical. It's trying to be long in uptrends. In neutral trends, it's trying not to chop itself up and churn itself up. And in downtrends, it's just out. As badly as I want to say, this is it. This is where we buy them. That's not how it works. That's not the rules. But I do think a barbell approach, Michael, is probably the best approach for most investors. By barbell, I mean try to find places to go that have held up the best, because that's probably where the fresh capital is going to be chasing returns and coming in if and when this turns around. But then also buy some of the hardest hit stuff you can find, because that's where the opportunities could be greatest. So if you're doing that, then you're not betting on just strength or just catching falling knives. You're being rational, and I think you're putting yourself in a position to benefit from a multitude of scenarios. So really quickly, what's working? The ITA is something that I own, bought it earlier this year. It's one of the few things I own that's working well. It's defense stocks. Look at those stocks today. Some of them are actually green. This is an area that is the second best performing after energy this year. Almost nobody is talking about any of these names. And there's so much geopolitical stuff going on right now. These stocks remain bid. I like that approach. I'm in IEO, which is energy also. Then on the weak side, I bought semiconductors recently. I wish I waited till today. But like that's an area that there's been so much pain there already, right? That I think if and when there is a turn of the market, there's going to be a lot of money made there. So doing that barbell approach is probably better than trying to buy a lottery ticket or like hit the jackpot on one specific trade.
So that's an interesting...
I was talking to one of the smartest people I know.
That's an interesting approach there Josh Brown's talking about, where essentially it's buying, things that have done well, like he said there, things like defense, things like, oil and gas stocks, let's call it that, and then buying, the beaten down plays, which for him was semiconductors, right? But you could go into a lot of different beaten up plays. Maybe that's a Shopify or maybe that's some of the small caps or things like that, right? Which isn't necessarily a bad strategy. It's not my favorite strategy, because just because something's been doing well does not mean it's going to continue to do well. For instance, or oil and gas stocks going to be great stocks for the next few years. I don't know about that. I'm not bullish on oil and gas stocks for the next several years in my personal opinion, right? Defense stocks. Yeah, there's a ton going on right now, and it's a scary time, and with everything going on geopolitically wise. But is that going to still be like that in 2 or 3 years? I don't know. Maybe it is. Or maybe things calm down there, right? These things go through cycles. And so I think that's just something to kind of keep in mind there. So I kind of like the approach of like you see stocks that are undervalued, buy 10 to 15 different stocks, have your money diversified around, and just continue to buy if they continue to dip and you love those companies, those 10 or 15 or maybe 20 companies if you're really diversified and you got a big portfolio or something like that, okay? Alrighty, we are ready to deploy our recession playbook, says Paul Tudor Jones. So what's he talking about here? What's his recession playbook? Okay.
Decade. The 70s were the decade of inflation. The 80s was a decade of kind of boom-bust, huge swings in dollar volatility. The 90s was equitization, the dot-com bubble. The aughts was the mortgage bubble and the great financial crisis. The teens were the peak of globalization and probably the peak of central bank experimentation with monetary policy, right? The 20s, I'm afraid, are going to be that period where we really focus on debt dynamics country by country, fiscal deficits, and the need to run certainly fiscal policy in a way that gives people confidence in the long-run value of the currency. And the problem that we've had really for the last 12 years is that we've done this massive experimentation with monetary policy where we suppressed yields, and we did this massive experimentation on the fiscal side during the pandemic. And so my guess is the 20s are going to be just the opposite of both. We're already seeing that right now from the central bank. Whoever is the president in 24 is going to be dealing with debt dynamics that are so dire. And so
so dire that this is the 1970s?
No, so dire that we're going to have fiscal retrenchment. And that fiscal retrenchment means that if we don't have fiscal retrenchment, that everything that we spent, if you think about the teens, which was all about suppressing yields, right? Mm-hmm. I think the 20s will be just the opposite. I mean, higher term premiums in bond markets, higher term premiums in stock markets. It'll be just the opposite of what we experienced the last decade. So in a time when there's too much money, which is why we have inflation, and too much fiscal spending, something like crypto, specifically Bitcoin and Ethereum, where there's a finite amount of that will have value at some point, someday. I don't know when that will be, but it will have value. That scarce.
And the value at a much higher number than where we are today.
Oh, I think so, yeah.
Like?
I would think, so we're probably getting ready to go through the recession playbook, more likely than not. Sometime, I don't know whether it started now or whether it started 2 months ago. You always find out, and you're always surprised about when recession officially starts. But I'm assuming we're going to go into one. There's a specific playbook around that.
There it goes again. The belief that we're not in a recession. And I don't need to go over all the different reasons why we are in recession, in 2022. It's there. Literally everything's there except unemployment.
What is that playbook?
Well, so that playbook is most recessions last about 300 days. From the commencement of it, the stock market's down, say, 10%. The first thing that will happen will be short rates will stop going up and will start going down before the stock market actually bottoms. So that's why you could argue that 2-year rates here may have some value, or somewhere through here. And term premium gets put back into a variety of assets, into bond markets, into stock markets, and that's obviously what's happening. So you're seeing multiples compress in the stock market, as they should, and you're starting to see bond markets sell off because, again, term premiums being put back into them. So I would say when we get into that recession, there will be a point when the Fed stops hiking. There will be a point when it starts to either slow down or even at some point it'll reverse those cuts. And when that happens, you'll probably have a massive rally in a variety of beaten down inflation trades, including crypto.
I want to bring Becky into the conversation because she's got a question, but when do you expect that to happen?
Well, look, we've got rates at unemployment rates at 3.6%, I believe. It's very possible we haven't even started yet. It's very possible that when the NBR goes back and says, here's when the recession officially started, that it'll be somewhere within a month or two of now. Maybe, I doubt, again, with the unemployment rate so low that they would date it earlier than this. They look at 6 or 7 different measures, and you're always surprised ex post when they do.
Yeah, they make up whatever they want to make up in terms of when they want to call it a recession, not a recession, apparently. But, that's a whole argument for another day, right? What he described there is almost a long-term investor's wet dream. Let's just call it that, okay? A situation where you can have a period of time where asset values are much lower than you would get them almost in any other cycle, right? And if we were just pull up, let's pull back up stocks here, okay? And if we were just to think about this on let's call it a practical level, right? And if you were to think about, like, what do you want to buy stocks at for pricing, right? And, the pricing you're getting now, so AMD's $57 here today, right? And who knows, maybe before this is all said and done, it's $47 or $37. Like, you never know where the end is, right? Or maybe 57, maybe this is the lowest it ever reached. We never know, okay? But the bottom line is, AMD was $160-something not that long ago. And entering this year, it was $150+. So as a long-term investor, right, as somebody that's a buyer year after year after year, in hopefully month after month after month, if you're in the right financial situation, right, where you have more income than expenses on a monthly basis, right, what do you want to pay? Do you want to pay $150 for AMD, or do you want to pay $57? Or do you want to pay $37, right? And so if you're a buyer of, let's say, AMD, I'm just using that as an example, right? I could use all these stocks as an example, Shopify, right? It doesn't matter. But if you're a real believer in AMD, would you rather load up shares of AMD at $50 for the next year, or would you rather load up an AMD at $150 over the next year? Well, obviously, you'd rather load up at $50, right? Because if you're planning on this being a stock you're in for the next 5-10 years, there's a much higher probability you're going to get a very nice rate of return when you're buying it at 50 versus 150, right? The valuations are completely different on what you're paying for that stock, right? Never mind, let's say AMD's not a dividend stock, but let's say it was a dividend stock. Then you're talking about a much bigger dividend yield as well, right? Hope you guys enjoyed today's video. As always, I appreciate everybody for joining me as always. Much love, and thanks everybody that subscribed to the channels. We are now, oh gosh, how many subscribers? 15,300 or something like that. Appreciate all you guys for being here as always. Also, if you're looking to join us in the private stock group, check out the pinned comment down there to apply to join us in there today or tomorrow. Much love as always, and have a great